Here are 10 option strategies that every investor should know. So first is the covered call. Now, the covered call is actually really, really useful in a lot of different circumstances, okay? If you own shares of a stock and you never plan on selling them, a covered call could be perfect for you. Now, how do we set up a covered call? Well, first off, you have to own shares. You can't or you can't set up a covered call unless you own the underlying shares to begin with. Now, remember that every options contract is worth 100 shares. One option contract is 100 shares. Okay. So if you own 500 shares of something, you'd need 5 option contracts to do this. Now, a covered call is in a nutshell a bearish trade. Sounds crazy, but it's a bearish trade. And the reason I say it's a bearish trade is because you're selling calls. Anytime you sell a call, that is a bearish move. Now you're owning the shares of stock and you're selling calls against it. Okay. So in this case here, this dotted line is what your P&L would look like if you own the stock buying it at $100. Okay. Buying it at 100, you're only going to make money if it goes up. You're going to lose money if it goes down. Right. We can see this. Now, in a nutshell, maybe it's not a bearish trade. Maybe that's a wrong way to put it. But in my opinion, it is. In my opinion, it is. Because you're really cutting yourself off at the heels. So you would sell the equivalent number, like we talked about earlier, against that call. So in this case, if it's 5, you own 500 shares of the SPY, you would sell 5 calls against it. Now, where would you sell it at? There's so many different ones you could sell. The rule of thumb that I always heard is you want to go for the 20 to 30 delta, meaning 20 means 80% of the time it's going to be out of the money. 30 means 70% of the time it's going to be out of the money. Okay. Now, this is actually really cool. You can stack this with a dividend paying stock and you can get paid the dividends and you can get paid the premium from the calls and you can make money on the appreciation of the asset. So you actually could profit 3 different ways, right? People love this, right? Like Justin, he loves covered calls, right? I assume is what he means. Oh, no, he probably means cash secured puts. Anyway, so on the covered call, you have, in theory, unlimited losses. Now, what do I mean by in theory you have unlimited losses? Because if we look at this, right, the stock can go down to whatever. And as long as you're still holding the stock, you have unlimited losses. You have a max cap that you can come across on the covered call. Because of that max cap that you can make on the calls, that's why I don't like it, right? If it does come up to, and let's use the 655 strike as our example. Let's say we sold 5 of the 655s. If the price comes up to the 655, that's the most you're going to make on the stock, right? Between 643 and 655, right? Wherever you bought it at, up to that point is the most you can make on the stock. So if we go back to this example here, from 100 to 110, right? This $10 move right here is the most you can make on the stock. Now you can actually make a little bit more because you sold the calls against it. Okay. So in this case, let's see how much did they sell the call for? I can't really tell from the screenshot here. Let's say they sold it for $3. They sold the calls for $3, which actually pushes their break-even point back from 100 to 97, which is pretty cool, right? I can definitely get behind somebody who wants to own the stock forever. They want to take the income from selling the calls, and if it goes down, their break-even point on this is actually at 97. That's a great start, right? Now, I'm not going to endorse this strategy because of a couple of different reasons. Number one is you have, in theory, unlimited losses, right? If you buy a call, you have capture losses. But in this case, if you're owning the shares, right? Like I say, it can go down forever and you can lose all the way down, right? But if you buy the call, you've capped your losses. Now, if you are doing the strategy, you're also putting up a ton of capital because you're putting up, let's just use round numbers here, right? If you are buying 5 at 100, right, you're actually putting up, or 500 shares at 100, you're putting up $5,000, right? 500 shares times 100. Am I get that right? 500 shares times $100 is $50,000. Okay, you're putting up $50,000. That's quite a lot of capital to tie up in a single trade. And then as it goes up, You can make money, but only up to a certain point. And then the calls that you sold will actually call the stock away from you. Actually call the stock away from you. So if it goes past the 655 in this instance, you no longer own the stock. The stock goes away. The stock goes away. And because of that, that is one of the reasons why I don't like the cover call strategy. Are there instances where this makes sense? Yes. And that would be if you plan to hold it forever and you understand that you're taking a buttload of risk by planning to hold it forever, because who knows how low it can go, and you want to collect the dividend income. I would only do this on dividend stocks. That way you get paid twice. Dividend income plus the income from the calls that you could do potentially every single month. So not an endorsement of this strategy, but this is the covered call. Now, a married put. This is really interesting here. A married put. You buy an asset. I haven't heard it called this before, but a married put, you buy a stock and you simultaneously purchase put options on the same number of shares. Okay. What I would call this is throwing good money after bad. Okay. Why would you do this? Why would you do this? Right? You're basically setting up a call option here. Now, what do I mean by setting up a call option? This is exactly what a call option looks like. Okay. You have capped the amount of risk you're willing to take, but you have unlimited gains. But this is a dumb way to do it. This is a super dumb way to do it, right? Because you still have to put up all the dollars for the shares, right? And we just talked about earlier, if you did 100 or 500 shares on $100 stock, that's $50,000, right? You still have to buy all the shares, and then you're buying puts. That's dumb. Why would you do this? Because your puts are going to expire worthless if the price of it goes up. In fact, this is a super duper dumb thing to do. I would never do this, right? Under no circumstance should you ever do a married put option strategy, okay? If this is what you want to do, which is the way that I set up my trades, just buy the calls, right? Let's do the math on this. Let's use and we'll simplify it by just doing one lots here, okay? So first, let's say I want to buy 100 shares of SPY, okay? So if I want to buy 100 shares of SPY, let me pull a spreadsheet here. Okay, so we want to buy SPY, buy 100 shares, and that's going to cost me 642. But this times this. Now we're not talking about margin. We're going to keep it simple here. All right, so we're buying 100 shares at 642. And then we want to go buy puts. All right, so we're going to buy one put, and that one put is going to cost us, what does it say? In the money or out of the money? Let's see. In the money or out of the money put. Buys a put option. And just it says just buys one put option. All right, so we'll just say in this case it's an at the money put option. All right, so then we're going to buy an at the money put option for, let's round it up to $7. Okay, for $7. Okay, so now I've just basically wasted $700. I've basically said, you know what? I've already spent $64,000. Why not just throw $700 into the trash can? Why not? Or if you just buy a long call at the 80 delta, right? At the 80 delta, which is what Chris does. And let's see how much that would cost us. $29.53. $29.53, right? And we multiply that by 100. So for $2,900, you can have literally the same setup. Not exactly to the penny, but 95% the same setup for $2,900 versus paying $64,000 to buy the stock, then throwing $700 and literally using it to light a cigar because you're so stupid for having done it this way. And I'll be on the other side using a leveraged investment for $2,953, right? So I'm going to spend 5% of what you're spending, and I'm going to have pretty much the same outcome. So under no circumstances ever in the history of time should you ever consider a married put. This is dumb. This is super dumb. The bull call spread. Now, we had somebody ask about this yesterday, and I feel like it's a really, really good topic to explain why I don't like a bull call spread. So a bull call spread is when you are buying most of the time and in the money call. So let's say that we bought the 80 delta call, right? Let's say we buy this call, but it's really expensive, right? 28.55 in this case. So in order to offset the cost of that, we're going to sell another call. So let me make this a little bit easier to follow. Let's go with the 620s here. Okay. So we're going to sell a call at the 625. By selling a call at the 625, now the cost of the whole option is $4.42. It's like, okay, sweet. Let's do this thing, right? There's a huge hang up here. A huge hang up here. Now, I want to preface this and say the idea of doing a spread from a cost perspective makes sense. But I'll show you in just a minute why I would never do this. At this stage of my career, the only thing I do is buy long calls. And when the market goes down, long puts, right? Is it sexy? No. Is it fun? Depends on your definition of fun, but it works. Okay. It works without all the extra complications. So let's see why we wouldn't want to do a bull call spread. So our delta here, let's call it 70. We'll round it. We'll give you 80, right? You bought this 80 delta put or 80 delta call. And then over here, you're like, you know what? That's too expensive for me. So I'm going to sell the 75 call. Okay. Do you see a huge problem with this? Does anybody see why this is a bad choice? Tell me in the chat, why is this a bad choice? Right? Yes, it is more expensive on purpose. It is more expensive for a reason. And because of that, by selling one against it, you are handicapping yourself bigly. All right. The reason why I don't like this is because you just took the 80 delta, which is the $1 change. I always say this wrong. It's the change in the option value for every $1 change in the stock. Okay. You took the 80 delta, which gives you 80% of the $1 move as the change in the option price. You can see the market just lit up, so things are going to move around. And then you handicapped it. This a moment ago was the 75 delta, and you sold 75 deltas against it. So you had an 80 delta. You took off 75 of those deltas. You have 5 deltas left. Yeah, you gave up all your deltas. You gave up the whole point of the trade. The whole point of the trade was to maximize how much you can make, and you just let most of it go out the window. Now, you can mitigate this by moving down the option chain some. Let's say you went with the 640 and then you sold the 645. And so that's 59 delta to 50 delta. So maybe you'd have 10 deltas. This is not a strategy that makes any sense to me. Does it cost less? Yes, it does cost less. But you're capping your gains. You're also capping your losses, which I like. But in the process, you just remove the efficacy, the efficiency of the option in the first place. That's why it costs so much more, because you're getting that leveraged investment on purpose, right? It's expensive for a reason. So that's definitely one I would not do. Now, a bear put spread, same thing on the put side. A bear put spread is exactly the same thing on the put side. Okay. It's you're buying a put in the money. You're selling a put against it, and you're just watching your deltas evaporate. Okay. So similar reason, I would never trade that. And look how much more risk you have in this particular setup here. A protective collar looks a lot like that bull call spread. It looks a lot like that bull call spread, right? Collar is done by purchasing an out of the money put option and simultaneously writing an at the money or out of the money call option. Okay. So in this case, we are selling a call option, which breaks the first rule of leverage, the golden rule of leverage, which is never put yourself in a situation where you can lose more than you can win. Okay, so we've sold a call option, which broke the golden rule of leverage. And then we are buying a put option against it. We're buying a put option against that. So we are capping our losses at that point. We're capping our losses at that point. But again, what's the point of doing this? What's you can't explain to me what the point of doing this is. You're adding complexity, you're adding issues, you're adding all kinds of potential problems that you don't need, right? You really don't need. So going with the long call solves a lot of these issues right here off the bat. And am I a hater on these strategies? Yes, I am a hater on all these strategies. Go ahead, leave the comments down below. I am a hater on all of these strategies. Does that mean that you should never use them? No. Maybe this fits your trading plan, but you're not keeping it simple, right? You're adding a lot of complexity here that doesn't need to be done. And honestly, I think the only reason that most people do these type of trades is just because it costs less. But like I told you a minute ago, it costs less for a reason. Let's go to the next one, a long straddle. Okay, I have a great story about long straddle. So back a few months ago, oh, look at our stocks up bigly this morning. Let's go. Let's go. Back a few months ago, NVIDIA was having earnings. And Mahesh, our CEO, he called me, and I think it was this earnings right here. He called me, he said, Chris, I don't know what's going to happen, but I know there's going to be a big move up or a big move down on NVIDIA. And because of that, I want to buy puts. Or I'm sorry, I want to buy a strategy that makes sense. And I was like, okay. So he's like, I'm going to buy an at the money straddle. I was like, why? He goes, because I don't know which way it's going to go, but I know it's going to go somewheres. Okay. All right. And the reason that you don't want to do this is because whenever we are buying an option, we want to maximize our intrinsic value, minimize our extrinsic value. When you buy a long straddle, you are maximizing the extrinsic value because look, the highest cost of extrinsic value is at the money. And you're basically spending as much as you possibly can for an option. You cannot spend any extra on this one because this is the highest amount of extrinsic value. Now, that also means the stock has to make a giant move one way or the other. A giant move to overcome the fact that you bought the most expensive option as far as extrinsic value goes in both directions. It has to overcome a huge, huge drawback. And because of that, it's very, very tough to make money on these, especially when it comes to earnings. Because with earnings, right, let's say that you spent $10 on this at earnings, okay? The day before earnings. Earnings comes out Thursday afternoon. Friday morning, you log in and you see that the stock price moved from $50 to $51, right? Not the big move you were looking for. But what's about to happen as well is within an hour after earnings, this $10 you buy it for is going to plummet in value, maybe down to $2. That's called implied volatility crush. So you may have spent $10 on Thursday, and by Friday, it's worth $2. And it's not even moved yet. So this is one of the reasons why you will never, ever in the history of time, every single day that God lets me walk his green earth, you will never see me buy a long straddle. It's just a fact. A long strangle. All right. Now, instead of being at the money, we're going out of the money, making things even harder, making this an almost even more impossible trade to win. Okay. So let's use these side by side. Let me clear my notes here. And you can see just how hard this one is going to be to win. Okay. Whereas at the money, it only has to move, so much to get to your break even. With an out of the money, you set your strikes further out of the money. So that makes it even wider of a gap to try and win from. Why would you ever do this? I did talk Mahesh out of it. Yeah, I did. Oh, you're welcome, Corey. Why would you ever do this? I can't imagine at any point in time anybody ever doing this. If you have a good reason to do a long strangle, please put it in the chat. I would love to know. Clearly, my itty bitty baby brain can't comprehend why anybody would ever want to do this. You're making this an almost impossible trade to win. But it's cheap, Chris. Yeah, bro, it's cheap for a reason. Right? It's like going to the department store and you see one shirt that's let me use a different example. You ever go on holiday, ever go on vacation, and you go to the souvenir shops, right? And it's like 4 shirts for $6. And it's like, oh, sweet, right? And you pick up the shirt, and you're like, Ugh. Right, Spring Break 1984. This shirt sucks. Right, and you pick up the next one, it's got mothballs all or moth holes eating all through it. And you pick the next one, you're like, it's got a picture of Barney walking on the beach or something. These are the shirts no one wants, right? That's why they're four for $12, 4 for $6, whatever the case is. They're cheap for a reason. Okay. But then you go to the other rack and you see the nice button down shirt that's got the fun beach prints on it, and it's $37. You're like, oh, that's because it's a nice shirt. It's a higher quality product. This is something that people actually are cool with spending money on because it is worth it. Right. And as a snob, as you guys know, not a reform snob, a proud snob, right? I'm only going to buy stuff that is worth money. There's no possible reason you could ever justify this particular options trade. I guess if you hate money, you know what? That must be it. If you actually hate the currency that you have, I was going to say United States dollars, but whatever currency you have, if you hate money, by all means, buy the mess out of these. Maybe every once in a while you'll make money on it, but the other 9 times out of 10 when you're losing money, yeah, it's not worth it. It's not worth it. These strategies are used for the same reason that Toyotas exist, but people still buy Kias, right? I don't buy Toyotas. I buy Lexuses. I have a Lexus GX. I was done, right? Because I'm a snob. But that's a fair point, right? They're cheap for a reason. They're cheap for a reason. AN. I'll go with AN. That AN sounds cool. AN says, never do it. People do it who do not understand options and the UI, making it simple for folks to do it without much understanding. Yeah, for sure. Robert says, hi to y'all. Thanks for the information. I forgot what to be a hater on. Definitely, I am a hater. I am a hater. Next, a butterfly spread. Now, this is actually a cool spread. I have traded some of these before. But this becomes a very difficult play. So whereas this one has to move bigly one direction or another, you've got to have a big move. What you're doing here is you're pegging a move. All right. Now, if you are the kind of person who wants to use profit targets, right? Let's say that you said, in this example, NVIDIA is going to go to 183, just for example. NVIDIA is down at 147. NVIDIA is going to go to 183 at this time, not currently. All right. And you're like, well, if it goes to 183, how do I maximize the amount that I can make? A butterfly spread totally could be that. But what you're doing is you're basically pinpointing a spot on the chart and say it must get to this point. And here's the worst part about it. It must get to this point at this time. At this time. Okay. The expiration cycle must coincide with when it's going to get to that point at that time, which makes this an infinitely, unbelievably difficult trade to pull off. If you get it right, though, you can make big bucks. And these are usually the cheapest little setups that you can put in. Like I'm talking, it may cost you $20 total, and you could be pulling out a $200, $500 win on that $20, right? But you have to be right on direction, and you have to be specifically right on timing, because the way that you maximize this is the day of expiration. Meaning, if it comes up to this point and then comes back down, you're still going to get nothing. You're still going to get nothing because it's requiring expiration to happen right around that time. There are a ton of variants, a lot of variables on butterflies. And the reason that I would never, ever do that. Iron condors. Oh, let me tell you. Iron condors were Chris's favorite strategy for years. I was like, okay, well, iron condors are brilliant. In fact, I probably have a whole section about how brilliant they are in this book right here. Don't listen to that guy. That guy didn't have enough experience to have written that book. Looking at this, right? This actually looks really cool. I'll tell you why it looks so cool. All right. So let's say the current price is right here. Let's call this 100. All right. The current price is 100. The price can go up and you make money. The price can go down and you can make money. Ah, that's really cool. Or the price can go nowhere and make money. Whoa, let's freaking go. I love this idea. And I did love this idea for years. But there are some huge problems with this. Some giant, no good, very bad problems with this. First problem is that the maximum loss on here is going to be well more than you can ever make, which of course violates the golden rule of leverage. Never put yourself in a situation where you can lose more than you can make. So for example, the maximum profit here in this one is $400, right? $400 maximum. You cannot win more than that. The maximum loss in this case, it's a little bit hard to tell with the way they set it up, but at least $600, all right? So $600 is the maximum loss, which is a decent risk to return for iron condors, right? Making 400, losing 600, right? Decent risk to return, but it still breaks the golden rule of leverage. Now, looking at this further down the road, you've probably got a 60% chance of this being right. But for example's sake, I'll give you a more real world of what it was like for me. Making 200 and losing 800, right? Making 200 and losing 800. This is more realistic as to what iron condors look like. Now, you're probably thinking to yourself, well, that's not that big a deal, right? I mean, if I'm winning 84% of the time, right? And every time I win, I make 200. And then every time I lose 800. And I've got an 84% win rate. Oh, okay, that'll be great. I could take that, right? This is what Chris lived, okay? I had 84% win rates, and every one trade that I put on would lose 4 to 6 times as much as every winning trade. Every losing trade could lose 4 to 6 times as much as every winning trade, which sucks, which means every one trade that you put on that loses, you now need to be right 4 to 6 times perfectly after that, perfectly executed after that. And like I say, it seems great on the outside. It really does seem great on the outside. And I even had 84% win rates. But at the end of the year, I would have less money in my account than I started with. And I'm like, how did I have less money in my account than I started with? How did I have less money in my account than I started with? And that's because even with 84% win rates, my losses were so much bigger than my wins that I was just losing money hand over fist. And it sucked. And it was really frustrating because I was like, I have found the holy grail of trading. It can go up, it can go down, it can go sideways, and I still make money. And I did make money 84% of the time, but it was the 16% of the time that I lost that really screwed me over. And then iron butterfly is just like the other butterfly we talked about earlier, but instead of picking strikes out of the money, you're picking strikes at the money. Again, a very difficult trade to pull off. And not to mention the 4 legs add up on fees, right? So this was a super, super quick lesson into 10 option strategies that anyone could know. But at the end of the day, the only strategy that I trade after 16 years of trading, I have basically boiled it down to long calls and long puts, maximizing my gains and minimizing my losses. That, at the end of the day, 16 years later, is what I boiled it down to. So you can try and go fancy, or you can try and use leverage in your favor, and that's what we like to teach over here. And if you want to learn how to save time, make money, and start winning with less risk, click one of these 2 videos, and we'll talk soon.